Certainly. What we're trying to do in the portfolio is build a portfolio really bottom up of high conviction stocks. And what we're looking for particularly is companies that give us a combination of high quality. That's companies that are producing good cash flows, using that cash flow to benefit shareholders, and combine that with stability. That's about stable business models that produce stable stock price performance, and we want to buy those characteristics at an attractive valuation, because obviously if you buy companies that cost too much, you're going to damage your returns over the long run. So that's what we're really looking for: quality, stability and price. And we're buying new companies when we really find them that have those characteristics. So obviously we're always wanting to change the portfolio a little bit if there are companies that have done well, no longer so attractively valued. And we're also at a high level wanting to make sure that the portfolio overall is well positioned, particularly to protect when markets are down, because that's what the portfolio is really all about. So recently, for example, adding a little bit more in some traditional defensive areas, a little bit less cyclical exposure in the portfolio. Yes, so it's been strong, I'm pleased to say. If you go right back to the launch of the fund in 2012, after fees, the institutional share class has produced a return of a little bit more than 11%. Annualised, that's about 1.5% more than the MSCI World Market, and it's done that with lower volatility. So the volatility of the fund has been around 9% versus 11% for the index. And I think what's really important, given the emphasis on downside protection, is if you look at that full period since we launched the fund, there have been 8 occasions when developed market equities have fallen by more than 5%, and the portfolio has strongly outperformed in all of them. So across those episodes, it's had a downside capture of just 70%. It's really just the result of bottom-up stock selection. So I suppose relative to a cap-weighted index, we're a little bit overweight Europe and a little bit underweight North America. That's not a kind of top-down asset allocation decision. It's really just where the bottom-up stock selection takes us. And I suppose what that's reflecting a little bit today is that valuations on average are a bit more stretched in the US and a bit more attractive in Europe. Yes, so I think there are a lot of risks we're concerned about for 2020. The most important probably is just straightforward slowing economic growth, and maybe at the outside a risk of outright recession. And so that's the key risk we're guarding against in the portfolio, by making sure we don't have too much exposure to stocks that are likely to do poorly if economic growth slows further. In terms of the financial system, of course, there are always risks there. I don't think we're seeing the same imbalances we did before the last crisis, but certainly we don't want the portfolio to be exposed to names where the systemic risk is high. So for example, we only have one fairly modest position in Eurozone banks in the portfolio today. Most of our banking exposure is in markets that seem a lot safer, like Canada or Singapore, and then we have financial exposure in other areas of the market altogether, specialist insurers, exchanges and so on, and not too much exposure to the banking sector.